Welcome back to the Deep Dive. Our mission, as always, is to take these massive, complex stacks of financial reports, of journalism, of industry analysis, and just distill them down.
We cut through the jargon to give you the essential knowledge you need to be genuinely well-informed.
And today, we are peering deep, deep into the engine room of modern finance.
We are. We're talking about the world of alternative asset management. This is a realm where, trillions of dollars are shifting ownership of global industry, and yet the firms themselves are often complete unknowns to the public.
Our focus today is on one of the absolute biggest, a true powerhouse, Apollo Global Management, Inc., or AGM.
That's right. And when we say their influence is everywhere, we mean it literally touches your daily life.
Yeah, we're talking about the cruise line you might book for your next vacation, the actual physical telecom lines carrying data to your phone.
The movie studio that makes the blockbuster you just watched, or even the regional television station that delivers your local news.
It's incredible. If Apollo hasn't owned it at some point, they've almost certainly provided the crucial financing that made it happen.
So our sources for this deep dive really illustrate the evolution of a remarkable financial machine. Our mission is to take you on a journey through Apollo's history.
We're tracing their path from a really niche, opportunistic firm born out of a financial collapse in the 90s.
All the way to becoming this diversified, multi-trillion-dollar manager of global capital. We want to understand the unique and sometimes, let's be honest, aggressive strategies that fueled this incredible growth.
And critically, how their business model has just fundamentally changed in the last 5 years.
There's a whole new game for them.
Okay, so let's unpack this with some perspective on their scale. As of early 2025, Apollo Global Management has a staggering $840 billion in assets under management, AUM.
It's a number that's almost hard to get your head around. To put that in context for you,
Yeah.
that is larger than the entire GDP of nations like Switzerland or Turkey. Yeah, and that near trillion-dollar figure, that's the pool of capital they manage and deploy on behalf of their clients. And these aren't small investors.
No, these are the giants. We're
Sure.
talking massive public and private pension funds, university endowments, sovereign wealth funds.
Exactly. It places them right at the apex of the alternative asset industry, right up there with their main competitors, Blackstone, KKR, TPG.
So that $840 billion figure is the headline, but it kind of obscures the more profound story, doesn't it?
It does.
So here's the big question that's going to drive our entire conversation. How did a firm founded just 35 years ago in 1990, starting with a first fund of only about $400 million, how did they manage to grow their portfolio exponentially to approach the trillion-dollar mark?
I mean, the strategy couldn't have just stayed the same. It had to pivot, and pivot dramatically with every single major economic cycle.
And that pivot, that's the key, right?
That pivot is the key to understanding Apollo's DNA. They are, at the end of the day, the ultimate financial chameleons.
Okay, so let's start at the beginning. The story of Apollo Global Management, it doesn't start in some quiet boardroom with a grand vision.
No, not at all. It starts with a spectacular financial catastrophe.
Picture this. The year is 1990, and the Wall Street giant Dressel Burnham Lambert has just collapsed. It sends these massive shockwaves through the entire financial system.
And it completely wipes out the high-yield bond market, the so-called junk bond market that they had essentially created.
That collapse didn't just end a firm, though. It dispersed a unique kind of talent across Wall Street.
And that's where Apollo comes from. It was founded by this core trio, Leon Black, Josh Harris, and Mark Rowan. We should also note Tony Ressler was among the original members.
And these weren't just any bankers. These are the high-flying executives who had lived and breathed the aggressive leveraged finance world of the 1980s, working directly under the famed Michael Milken.
So when Drexel imploded, they didn't just pack it in. They immediately saw opportunity in the wreckage they understood better than anyone else on the planet.
They founded their firm, initially called Apollo Advisors, in the immediate aftermath of that market crash. But the playbook they knew, the traditional leverage buyout, or LBO, it was dead. You just couldn't get easy debt financing anymore.
And that necessity, that's the mother of their most famous invention, the strategy of distress to control.
This was their critical divergence, and it really defined their entire approach for that first decade.
Right. They couldn't raise money to buy healthy companies with new debt, so they decided to buy the failures.
Okay, let's unpack that. Distress to control. So instead of a hostile takeover or a typical LBO, they're targeting companies that are already struggling.
Exactly. Companies whose high-yield debt had just plummeted in value because they were in bankruptcy or about to default.
So they'd step in and buy that debt.
They'd buy that depressed, defaulted debt, often at a huge discount, maybe 30, 40 cents on the dollar. Then, through the restructuring process, they'd use those debt holdings as leverage.
Leverage to demand. Equity.
Precisely. They converted their ownership of the distressed securities into a controlling equity interest in the newly reorganized company.
It's a brilliant, if incredibly complex, maneuver. They weren't just fixing a balance sheet, they were acquiring ownership on the cheap by becoming the company's biggest creditor.
And their first fund, Apollo Investment Fund LP, launched in 1990, only raised about $400 million.
Which, sounds like a lot, but it was small compared to the LBO funds that came before it.
It was. And that capital was secured almost entirely on the reputation of Leon Black, given his seniority at Drexel and his experience managing these kinds of complex restructurings.
And they put that strategy to work immediately, right? Often buying stakes in assets that their old firm, Drexel, had helped finance in the first place.
Oh, yeah. You see this in their early portfolio. Vail Resorts, Walter Industries, Culligan, Samsonite. They were essentially acting as liquidators and, restorers of value for assets that had been over-leveraged during the 80s boom.
But the most famous and maybe the most controversial use of this strategy was the deal for Executive Life Insurance Company's bond portfolio in 1991.
Oh.
The success of this one deal was just foundational for Apollo.
It was a massive win for them. Executive Life had collapsed because it was holding this huge portfolio of those now toxic, high-yield bonds that Drexel had popularized.
So Apollo swoops in, buys those bonds.
And when the market for junk debt unexpectedly recovered, they generated enormous profits. But the deal itself was legally fraught.
This is where the details really matter. The acquisition was facilitated by a French government-owned bank, Credit Lyonnais.
Right, and at the time, California state law prohibited foreign government entities from owning controlling stakes in domestic insurance assets.
So to get around that law,
they structured the deal in this incredibly complex way that, according to later regulatory and legal reviews, basically obscured Credit Lyonnais's true role in the whole financing and ownership structure.
So this one deal became the subject of long, complicated regulatory issues with the state of California. It really set a precedent, didn't it?
It did. It showed that Apollo was comfortable operating right on the very edge of legal and regulatory boundaries to get the financial results they wanted.
Okay, so the foundation was laid in distressed assets, but the firm scaled and diversified so quickly. Let's fast forward to their IPO in 2011.
Right. Apollo isn't just a private equity firm anymore. It becomes this publicly traded asset management behemoth listed on the NYSE as APO, and now it's a component of the S&P 500 index.
And that public status is so important because it means we can actually look behind the curtain. We get clear financial reporting.
And the scale is just immense, as we said. If you look at the 2024 financial data, Apollo reported $26.11 billion in revenue and a net income of $6.373 billion.
Let's frame that for a second. $6.4 billion in net income isn't just big. It places them among the most profitable financial institutions on the entire planet.
It demonstrates that the business of managing capital for others is a high-margin, high-velocity operation when you do it at this kind of scale.
And the real story of their current size is in that AUM breakdown for 2025. That $840 billion isn't all in one bucket.
No, it's highly diversified.
You mentioned the distinction between the funds. When most people think of Apollo, they think private equity, the LBOs, the ownership stakes. But that's only $99 billion of the total.
A surprisingly small slice of the pie.
The true engine of the modern Apollo is their credit business.
Absolutely. Credit makes up the overwhelming majority of their capital deployment. $392 billion.
Almost $500 billion.
It's their largest investment category, and it represents a massive industrialized version of their original distressed debt DNA. It includes everything from non-performing loans and syndicated bank loans to structured products like collateralized loan obligations, CLOs, and mezzanine capital.
So they aren't just buying companies anymore. They are a primary provider of debt financing to the entire global market.
Their history shows they're experts at managing debt risk, and today they've just institutionalized that skill, turning it into a vast revenue stream.
And then you have this growing category of real assets, real estate, critical infrastructure, which accounts for $46.2 billion. That signals a really aggressive push into physical long-term holdings.
They're a true multi-asset manager. They offer clients exposure to everything from equity ownership to secured loans and hard assets. We should also make a quick distinction for the listener about the Apollo Investment Corporation, or AIC.
This gets a little technical, but it's important for understanding the market.
Right. AIC is a separate, publicly traded company called a business development company, or BDC. A BDC acts almost like a closed-end fund that invests in smaller, private companies.
So AIC specifically provides that mezzanine debt, the senior secured loans, and equity to middle market companies.
Exactly. It offers public investors a way to get a piece of the private credit world that Apollo so thoroughly dominates.
And before we move into the LBO era, we have to talk about the talent that spun out of Apollo. The other major player, Ares Management, has its roots right here.
It does. Ares was founded in 1997 by Anthony Ressler, John Kissick, and Bennett Rosenthal, the latter two being Apollo partners. Initially, Ares was basically Apollo's West Coast affiliate.
It was created specifically to manage those sophisticated debt vehicles, like collateralized debt obligations.
They kept that close relationship for a while, but in 2002, Ares did a full corporate spinoff. And it's telling that the separation happened around the same time Apollo was having all those legal difficulties over the executive life deal in California.
It suggests maybe a strategic separation, or at least a divergence in how they wanted to operate.
Regardless, it just underscores that the Drexel diaspora didn't just create Apollo, it seeded the entire alternative asset industry with these new aggressive firms.
Okay, so let's transition into the mid-2000s.
Yeah.
The entire financial environment shifts.
Dramatically. Credit markets open back up, interest rates are low, and the global LBO boom is on. Apollo, having mastered the art of managing troubled debt, was perfectly positioned to just swallow corporate giants with new debt.
And you can track this confidence in market access just by looking at their fundraising.
Yeah.
Their flagship Fund 6, raised in 2005, hits $10.2 billion.
And then, here's where the audacity really comes in. Despite the storm clouds gathering for the 2008 financial crisis, they go out and close their Fund 7 for a massive $14.7 billion.
In late 2008.
In late 2008, when global finance was completely seizing up, that tells you everything you need to know about their reputation and their investors' belief in their crisis management model. They had the capital ready to go just as assets were crashing.
Masters of timing.
Absolutely. And they deployed that capital aggressively in these mega deals, often partnering with rivals. The most famous was probably the leveraged buyout of Harrah's Entertainment,
Which owns the Caesars Palace casino empire. They bought it with TPG Capital in January 2008 for $27.4 billion. And critically, that price included assuming all the existing debt.
The leverage used in that Harrah's deal became a major case study in financial engineering. Another huge acquisition that proved, let's say, highly susceptible to the market crash was Realogy.
Right, they bought Realogy in 2007 for $8.5 billion.
And Realogy is the franchisor behind all those real estate brands you see everywhere. Coldwell Banker, Century 21, Sotheby's International Realty.
So they're buying a massive real estate holding company right before the housing bubble pops.
Which means they inherited an immediate crushing debt load. I mean, many other LBOs from 07 and 08 just ended in total ruin.
But what's fascinating is that Apollo managed to survive the Realogy deal.
Yeah.
They eventually exited the investment in 2013, making an astounding $1.3 billion profit.
This wasn't a quick flip. This required serious operational discipline and an extremely shrewd long-term vision to navigate the worst housing market since the Great Depression.
But not every deal showed that kind of resilience. The Hecht and Huntsman saga is a textbook example of the high-stakes legal and financial risks they were willing to take.
Oh, this is a mess. So Hecht Specialty Chemicals was a company Apollo created in 2005. In 2007, Hecht tried to acquire its rival, Huntsman Corporation, for $6.5 billion.
And then the financial markets collapsed right after they agreed to the deal.
Right. The credit crunch meant Hecht's debt burden would be completely untenable, so they tried to back out. They just refused to close the acquisition.
And Huntsman, unsurprisingly, sued.
The legal firestorm was front-page news. Ultimately, Hecht settled with Huntsman in 2008, and the settlement required Hecht to pay Huntsman a staggering $1 billion.
$1 billion, just to drop the fraud and breach of contract charges.
$1 billion. That's not a rounding error, even for a firm deploying $14 billion in capital. It just highlights the aggressive, litigious environment they were operating in.
Meanwhile, they just kept diversifying, right?
Yeah.
Buying up essential industrial assets.
Yeah. Rexnord for $1.825 billion, Berry Plastics for $2.25 billion, Jacuzzi Brands for almost $1 billion. And they also made a highly strategic, counter-cyclical investment.
Your cruise line.
Norwegian Cruise Line. They stepped in with a $1 billion investment in 2008 to recapitalize the company, which is what helped it survive the economic contraction.
That cruise line deal proved to be really strategic, but that period, '07 to '09, was just characterized by navigating genuine financial peril. They had some painful losses alongside the wins.
Absolutely. One highly scrutinized deal involved commercial real estate loans. In April 2008, Apollo partnered with TPG and Blackstone to buy a $12.5 billion portfolio of senior secured bank loans from Citigroup.
These were loans cities had made to finance LBOs at the peak of the market, and now they couldn't offload them.
Citi was desperate to clear its books, so the loans were reportedly sold at around mid-80 cents on the dollar. Apollo and its partners thought they were getting a great deal.
But the market kept sinking.
And by late 2008, the value of those assets had plummeted even further, and Apollo was facing significant margin calls on the financing they had used to buy the portfolio. The crisis didn't spare even the opportunistic buyers.
And then there was the total write-off, the brutal reminder of failure.
Linens and things.
They had invested heavily in the U.S. retailer back in 2005. But the combination of its massive debt load and the rapid collapse in consumer spending
meant the company filed for bankruptcy in May 2008.
And that bankruptcy cost Apollo its entire $365 million investment. It was just wiped out.
It's critical to remember those losses that shaped their risk profile. That $365 million was gone, and it taught them a painful lesson about retail exposure during a severe recession.
So in situations where companies were struggling but maybe salvageable, Apollo used some clever financial engineering to keep them afloat. They deployed this highly scrutinized strategy called the PK toggle.
Let's define PIK for the listener. It stands for payment in kind. This tactic was used when a portfolio company, like the retailer Claire's Stores, was under intense pressure and couldn't make its cash interest payments on its debt.
So wait, Apollo, as the owner of the debt, could exercise this PIK toggle option. Instead of the company paying cash interest, which it didn't have,
it issued more debt to cover the interest it owed.
So you're paying debt with more debt.
Precisely. It's a deferral mechanism. It allowed the company to preserve cash flow right then, providing immediate temporary flexibility. But you're right, it came at a terrible cost.
You're not solving the problem. You're just kicking the can down the road and making the can bigger.
You are compounding it. You're adding the interest payments back onto the principal, guaranteeing a much larger, more difficult debt crisis later on. It was pure financial triage to keep the company solvent until the market hopefully recovered.
And that must have been heavily criticized.
Oh, it was. Restructuring analysts saw it as maximizing the immediate return for the debt owner, Apollo, at the expense of the company's long-term health. But since they own both the equity and the debt, they were just moving pieces on their own chessboard, buying time for the equity value to recover.
So, successfully navigating the crisis, their reputation for distressed investing is cemented. And Apollo completes its IPO on March 29, 2011.
And now, with access to public markets, the whole calculus changes. They're no longer just answerable to their limited partners. They're answerable to every public market investor who demands consistent growth and diversification.
And that post-IPO era is defined by this aggressive expansion away from their traditional focus.
Yeah, away from distressed manufacturing and chemicals. We see a huge shift into consumer services and intangible assets. They just dove headfirst into education.
Which is a surprising choice. In 2012, they buy McGraw-Hill Education for $2.5 billion. And then, 5 years later, they acquire the entire Apollo Education Group, the parent of the University of Phoenix, for $1.14 billion.
It suggests a really strategic bet on the financialization of educational content and services. At the same time, they became highly active in entertainment and leisure.
And they proved they were adept at the rapid flip.
They were. They acquired Great Wolf Resorts in 2012 for $703 million and sold it just 3 years later for $1.35 billion, a near doubling of their capital in a pretty short time.
And then, of course, the acquisition that everyone can relate to. They literally saved the American snack aisle.
The Twinkie deal. In 2013, they secured the winning bid for the snacks business of the bankrupt Hostess Brands for $410 million. It's a great example of applying that distressed asset expertise to a high-visibility consumer brand.
But while they were saving Twinkies, they were also moving into much more serious infrastructure and security assets.
Right. They acquired the ADT Corporation, the massive residential security provider, in 2016 for $6.9 billion, and the cloud computing company Rackspace in the same year.
That move into technology and security, it signals their growing interest in services with strong recurring revenue streams.
And this period also features an acquisition that thrust them directly into the geopolitical spotlight, the 2016 purchase of Constellus for $1 billion.
Constellus is a major private military contractor, and its structure included Academi.
Which listeners will know better by its former name, Blackwater USA.
This is a critical detail. It meant that Apollo, a financial firm managing pension money, now owned a company directly involved in national security and foreign military operations around the globe.
Given the very serious historical context of the Nice-R Square massacre involving Blackwater Guards, acquiring a private military contractor just demonstrates the full depth of Apollo's mandate.
They're operating in sectors traditionally reserved for governments or highly specialized defense companies. It's this direct link between finance, geopolitics, and military operations.
Let's shift to their media strategy, which really shows how they can consolidate vast market sectors very, very quickly. Look at the complex deal for Cox Media Group in 2019.
This was a multifaceted $3.1 billion deal. Apollo structured it through a new entity called Terrier Media, which later just took the Cox Media Group name.
And this transaction involves simultaneously acquiring 13 Cox TV stations, 54 radio stations, and all the associated ad businesses.
And it didn't stop there. They concurrently acquired Northwest Broadcasting, bringing their total TV station count to 25. It shows this deep appetite for mass media consolidation.
The complexity of these deals often triggers regulatory action. For instance, the FCC actually required Apollo to sell the Ohio newspapers they had acquired back to Cox Enterprises in 2020.
So sometimes regulatory cleanup is just part of the process.
It is. They also achieved a really clean consolidation in the retail photo space. In 2019, they acquired Shutterfly for $2.7 billion and almost at the same time bought its direct competitor, Snapfish, for around $300 million.
They basically owned the entire consumer photo printing market overnight.
And the financial services sector, of course, that remained the constant. They bought Aspen Insurance for $2.6 billion in 2019, further building out their insurance assets. And crucially, they were also acting as a primary debt facilitator for other firms' deals.
Like providing $1.8 billion in debt financing for New Media Investment Group's massive acquisition of Gannett. It just shows their continued importance as a market maker.
And we have to touch on one deal that underscores how deeply interwoven these firms are with the highest levels of influence. Our sources highlight a politically noteworthy real estate transaction in 2017.
That's the $184 million loan provided by Apollo to Kushner Companies to refinance a mortgage on a Chicago skyscraper.
And the timing is what's important. The loan followed meetings at the White House with company executives. Now, the source simply presents the facts of the loan and the meetings, but it illustrates the critical role firms like Apollo play not just in finance, but in the political and real estate capitals of the world.
Their capital flows are often tied to major political actors and decisions.
So the era from 2020 to the present, it's defined by one single strategic objective for Apollo.
Achieving financial immortality.
That's a good way to put it. Securing a dedicated source of capital that never expires. And this led to their most critical strategic move ever, the Athene merger.
This is the culmination of everything they learned in the previous 3 decades. They mastered distressed debt, they mastered the LBO boom, but they were still constrained by the cycle of fundraising.
Right, that traditional model where you raise a fund, you invest for 5 years, try to exit over the next 5, and then you have to go back to your pension funds and, ask for more money.
That fundraising cycle introduces risk and uncertainty. The Athene merger, which was completed in January 2022 and valued at $11 billion, it solved that problem. It provided them with permanent capital.
And let's unpack the significance of permanent capital, because it is the holy grail of modern private equity. Athene is a retirement services and insurance business.
So when customers pay premiums to Athene for annuities and life insurance, Athene assumes a long-term liability. It has to pay that money back plus interest, years or even decades down the line.
But in the meantime, Athene is sitting on this massive, continuous, and highly stable pool of cash flow. This float, this capital, is managed by Apollo.
And since the liabilities are decades away, Apollo can invest that money in long-duration, less liquid, high-yielding assets, exactly the kind of complex credit and infrastructure deals they love.
The merger with Athene completely transformed their balance sheet. Apollo now had a dedicated, continuous, vast pool of money that isn't locked into a traditional 10-year fund lifespan.
It gives them unrivaled stability and flexibility. It insulates them from short-term market fluctuations and the constant need to be fundraising.
And the market has clearly rewarded this strategic shift. The scale of their fundraising continues unabated. I mean, Fund IX in 2017 raised a then record $24.6 billion dollars, and their latest, Fund X, closed in 2023 with another whopping $19.877 billion dollars.
And this expansion is also global. We see a clear push into the Asia-Pacific region.
Yeah, evidenced by their strategic partnership with Shinhan Life in Korea and the opening of a new office in Seoul, both in late 2024. They are deploying this permanent capital model globally.
And with this massive, stable capital base, their acquisition strategy has become almost overwhelming in its scope. Looking at the recent deals, it's a corporate shopping spree targeting the foundational elements of the global economy.
Let's start with media and telecom infrastructure. In September 2021, Apollo Funds acquired a 90% stake in Yahoo.
They now own a huge foundational piece of the original internet landscape, betting on its media and ad revenue streams.
And speaking of physical infrastructure, in 2021, they acquired the local exchange carrier operations across 20 states from Lumen Technologies for $7.5 billion.
They are quite literally buying the copper, the fiber, the switching centers, the physical backbone of U.S. regional telecommunications.
They're also consolidating the retail and consumer space. They acquired the Michaels Companies, the craft retailer, for $5 billion in 2021 and provided a $1.75 billion investment in Albertsons.
And they even moved into local food retail, buying up regional grocery chains like Tony's Fresh Market in Chicago and Cardenas Markets in California in 2022. It just shows the capillary-like reach of their investments.
And then there's heavy industry. They're investing heavily in manufacturing. Tenneco for $7.1 billion, Arconic in 2023, and the recent acquisition of Barnes Group in January 2025. These are global suppliers of automotive parts, specialized manufacturing.
But the single most significant recent deal, the one that demonstrates the ultimate application of their permanent capital strategy, has to be the mega infrastructure joint venture with Intel.
This deal is on a governmental scale. In June 2024, Apollo announced it was acquiring a 49% equity interest in a joint venture related to Intel Ireland's Fab 34. The deal was valued at $11 billion.
And Fab 34 is not a distressed retailer. It's a critical, advanced semiconductor fabrication plant.
It's high-tech, strategic infrastructure vital to the global supply chain and national industrial policy. Securing nearly half ownership in a cutting-edge chip facility is not a quick LBO. It's a strategic, long-term bet on the stability of global supply chain assets, exactly the type of asset their Athene-backed permanent capital is designed to hold.
So just when you think you've mapped their entire strategy, from chemicals to telecom to semiconductors, they dive headfirst into the high-profile, high-emotion world of professional sports.
The last few months of 2025 reveal this rapid, aggressive move into global sports ownership. And the strategic interest here is less about team profitability and more about the guaranteed accelerating revenue from broadcast rights, sponsorship, and streaming.
The specific examples are huge. In November 2025, they acquired 55% of the shares of Atletico Madrid, making them the majority shareholder of one of Europe's most visible football clubs.
And, maybe more surprisingly, in December 2025, they acquired a minority stake in Wrexham AFC, the Welsh club that's gotten so much global media attention.
This confirms a really serious commitment, one that was solidified earlier in September 2025, with plans to launch a separate $3.75 billion investment vehicle focused entirely on the sports sector.
That's a dedicated fund just for global sports. They are clearly looking to own large, stable pieces of the global sports media ecosystem, viewing them as long-duration assets, just like infrastructure or insurance companies.
They're also active in the broader entertainment landscape. While they sold their stake in Endemol Shine Group, they later acquired a minority stake in Legendary Entertainment, the studio behind massive film franchises, for $760 million in 2022.
It demonstrates an effort to control the content creation as well as the infrastructure that distributes it.
So the incredible scale and relentless growth we just detailed, it came at a price. And that relentless pursuit of capital led to a massive internal upheaval at the very top of the organization.
This is the biggest inflection point in Apollo's corporate history. The effective removal of its charismatic founder. Leon Black resigned as CEO and chairman in March 2021.
His resignation followed sexual misconduct allegations and the highly public revelation that he had paid the convicted sex offender Jeffrey Epstein $158 million for personal tax advice between 2012 and 2017.
The firm responded very quickly amidst significant investor pressure and reputational risk. Co-founder Mark Rowan immediately stepped into the CEO role.
And that leadership change signaled a necessary shift toward institutionalizing the firm, moving away from the dominance of its founder's personality.
The transition completely reshaped the top management. Co-founder Josh Harris also departed in January 2022 to focus on other ventures, meaning Mark Rowan is now the sole remaining founder actively steering the company.
Ushering in what many see as the new, more institutional era of Apollo.
And if we connect this back to the bigger picture, Apollo's founding DNA, that aggressive, high-risk, distress-to-control strategy, it doesn't just disappear even as they transition to permanent capital.
The firm's relentless drive for efficiency sometimes comes with a considerable human or financial cost that our sources really can't ignore.
We've already discussed the painful financial failures, like the total $365 million loss on Linens and Things, and the staggering $1 billion legal penalty in the Hexen Huntsman fraud case.
That level of financial exposure and penalty speaks volumes about the aggressive win-at-all-costs philosophy that underpin their operations for decades.
But the concern goes beyond financial damage. It extends to the operational practices of the companies they control, particularly concerning labor and safety. For instance, in July 2021, Apollo Funds acquired EmployBridge, which is one of the largest industrial staffing companies in the U.S.
Right, so EmployBridge provides temporary workers to a huge range of industries. And the source material notes that this company has been cited for dozens of safety violations and wage infractions over the past 2 decades.
This raises a really important question for you, the listener. What level of responsibility do these private equity owners assume for the operational practices and labor records of the companies they control, especially when maximizing financial efficiency and minimizing cost is paramount?
It creates this fundamental tension, doesn't it? Apollo's success is built on acquiring complex or struggling assets and injecting massive leverage or intense operational discipline to maximize returns.
But that relentless pursuit of returns for pension funds can sometimes conflict directly with basic priorities like job stability, wage compliance, or workplace safety. It is the hidden calculus of private capital ownership.
Nonetheless, Apollo is a true giant, both in scale and influence. They rank highly on industry lists, standing 29th in the PEI 300 ranking for 2024, competing directly with firms like Blackstone, KKR, TPG, and Carlyle Group.
The synthesis of their journey is clear. They have successfully navigated a massive institutional transition. They started as this specialized, opportunistic recovery fund after the Drexel collapse, where they basically weaponized financial crisis.
Today, they're a hyper-diversified, multi-billion-dollar asset manager that strategically uses not only traditional private equity and distressed debt, but also massive continuous credit funds.
And crucially, they have secured that permanent capital structure provided by the Athene merger, which is their ticket to long-term stability.
And that structure allows them to finance everything from complex consumer acquisitions like Twinkies and Michaels to industrial giants like Tenneco to global media assets like Yahoo.
All the way to critical national infrastructure like the physical telecom lines of Lumen, and now even major European football clubs like Atletico Madrid.
Their ability to shift focus from early distressed asset acquisition to LBO boom participation to securing that permanent capital base needed for acquiring vast critical infrastructure like Intel's Fab 34. That's the ultimate reason they've gone from $400 million to nearly $1 trillion in AUM.
They evolved from being dependent on financial cycles to essentially building a machine that smooths them out.
What an extraordinary journey. I mean, we started with the distressed securities of 1990, and we've concluded with a firm that manages nearly $1 trillion, dictating ownership of everything from global telecommunications lines to Major League sports teams. It's a masterclass in strategic evolution.
The transformation is truly extraordinary. Apollo successfully transitioned from being a purely reactive firm, an opportunistic recovery fund for the 90s debt collapse, to a global financial behemoth that proactively designs its own financial future through strategic mergers and securing that long-duration capital.
And the ultimate connection to you, the learner, is just how profoundly pervasive this capital is. The investment choices made by Apollo impact the prices you pay at grocery stores like Tony's or Cardenas, the security system protecting your home, ADT, and the news you consume through Cox Media Group.
Private capital has truly seeped into every critical corner of daily consumer and civic life.
And this leads us to our final provocative thought for you to mull over. Apollo's modern strategy relies so heavily on accumulating massive, long-term, and physical assets, real estate, infrastructure, telecom operations, and critical facilities like Intel's Fab 34.
So given that their funding relies increasingly on credit funds and that permanent capital from Athene, how might Apollo's strategy of accumulating these strategic long-duration assets insulate them during the next major global economic shift? And maybe more importantly, what does it imply for national economic resilience when vital infrastructure is increasingly owned and optimized by firms managing international pension capital?
The future of infrastructure and security often lies in the balance sheets of these massive asset managers. Something to mull over until our next deep dive. Thanks for joining us.
Until next time.